Are pension funds going to go bankrupt in the current environment? It is very unlikely, but we need to look at the very significant risks created by the years of allegedly cheap money and massive liquidity injections. Pension state funds and unfunded liabilities are not a problem of 2022. They were a problem in 2018, in 2019. The size of unfunded pension fund liabilities was only rising in the period of very cheap money. Why? Very simple. You had negative nominal and real yielding bonds that were sent into the pension funds. Those pension funds had to provide a certain level of liquidity, had to provide a certain level of return. They took very aggressive positions in order to manage the risk of interest rates and the risk of inflation with derivatives. And once the price of bonds collapsed, as we have seen in 2022, the worst year since 1931 for bonds, when those prices collapse, all the margin calls start to come up. And obviously, then, in order to generate some liquidity, those pension funds sell the most liquid assets, which are sovereign bonds, which creates further turmoil in those sovereign bonds, and prices go down yet again. The problem is not 2022. The problem was 2008 to 2018. This idea that central banks would constantly bring artificially the price of bonds up by lowering yields, by repurchasing those bonds, and creating the situation in which those bonds would only appreciate even if the yield was negative in nominal and real terms. High-yield bonds were trading at 3, maybe 2% yields. We saw the level of negative yielding bonds in the Eurozone and in Japan reach more than 17 trillion at some point, and it was almost 12 trillion in 2021. It's such an enormous bubble that's a decrease in price like the one that we have seen in 2022 because inflation started to pick up, because margin calls started to get triggered, because the liquidity providers were not there to purchase more hugely expensive bonds. All of that is creating a big problem, but it's not a 2008 problem, because the likelihood of contagion to other assets is much smaller, because despite what everybody is saying, central banks are hugely accommodative and continue to fuel that bubble. And also because the position of banks is not the same. So in terms of core capital, banks have a much stronger position than what they had in a period in which they were loaded with toxic sovereign bonds. The problem is, as always, an absolutely negative policy of bringing artificially interest rates down, bringing the price of the riskiest bonds to levels that are completely detached from the reality of solvency and liquidity, and artificially lowering the yields of sovereign bonds. All of that is basically bursting at the same time in an environment in which the inflation that everybody in those funds and in the mainstream said was going to be transitory results as not transitory. More importantly, what we need to remember out of all of this is not that 2022 is creating huge risks for the market. Is that that risk was created by the monstrously aggressive policy of 2020 and the previous years.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.